Hello and welcome to the Rupee Rakshak news of 22nd September 2023. This is a news for investors from a registered financial advisor. So this is authentic, unbiased, and news that you can use. Let's look at the global market updates this week. For global updates, let us welcome our expert, Mr. Venkat Tyagarajan. What is your view on the global markets this week? What are the factors moving the markets, and what are the factors that are important for the investors to keep in mind?
The story of the week is all about global inflation and global bond yields, and of course the number of central banks that met. First, let's talk about the Fed decision. In keeping with what market had expected, the Fed kept the Fed funds rate unchanged at its FOMC meeting yesterday at 5.25%, 5.5%, the highest range in 22 years. It is the second time in 4 months that Fed had skipped rising interest rates after a 10-meeting stretch of rate hikes dating back to the onset of the tightening cycle in March 22. For the context, the Fed's cumulative total increase remains at 525 basis points, with a total increase of 100 basis points occurring in 2023. This is a clear signal to the markets that it is committed to keeping interest rates higher for longer, as it has continued to convey in every meeting since it started to increase interest rates in this cycle. Now, first of all, why are they rushing? When all is said and done, the headline inflation is creeping up towards 4%, while core inflation remains stuck near 4%. The economy is still growing above the trend and the labor market remains extremely tight. Financial conditions are the loosest since early March 2022, before the Fed started hiking. Simply put, the current conditions warrant further tightening. The second factor, US bond markets. Although Fed has not hiked the rates, the market rates have tightened considerably. Bond markets seem to make historic moves every day now. It is obvious that nearly 3 years of inflation well above the Fed's 2% target, elevated US deficits, and rising debt to GDP ratio suggest that long-term yields are likely to continue to rise. But markets have so far remained dismissive of Fed's assertion and continue to expect a return of benign monetary conditions and easier money. It's only in the recent days that the market realized that Fed is talking serious and that accommodative door is fully shut. Fed pivot is no longer the fascination of markets anymore. For context, 2-year US Treasury yield has moved up to 5.17%, the highest since June 2007. A year ago, can you believe, this rate was at 3.85%. And 2 years ago, it was at 0.23%. From 0.23% 2 years ago, now to 5.17%. So basically, you can understand the gravity of this move. You can't dismiss this as a pinprick anymore, as you did earlier. So what is the impact on equity markets? Regarding Nifty, our view of standing aside proved to be right. Little bit of fear is coming, but still greed is overwhelming emotion. At 19,700 plus, the markets are richly priced, you ought to admit, taking into account the newer realities of higher for longer rates both in global as well as domestic markets. The Nifty should cool off further in keeping with the current macro dynamics. 19,250 could offer support, and the old range of 19,250, 19,550 might come back as some sort of a core range. The merchandise trade deficit numbers released during the week are worrying that it reflects the impact of overvalued rupee to a large extent. Answer to solving this problem is either a rate hike or a weakening the currency in tandem with what's happening in the rest of the world. The selling intervention is holding the dollar rupee at these levels, let's say 83.10, 83.20, and another rally in oil prices or a global yield next week should see USD INR breaking above the historic high of 83.29 and setting off a rally towards 83.75, 83.85 zone.
Thank you, Mr. Tyagarajan, for your updates and insights on the global markets and the global economy. Thank you for watching this week's episode. Please keep coming back every Friday at the same time.